Good good morning, good afternoon, good evening, everyone. Thank you once again for being here with us and for me we've been doing for the past for more than a year, and we are thankful for the patronage. We're happy about the comments we do receive from those who participate in order to help us select topics we should speak on. We are always elated to do that. And one of the things we are happy always to do is to bring knowledge, to have discussions, to answer questions, and to demystify myths around ESG and how its growing presence on Africa is affecting the way we think and then the way we do our businesses. So thank you to UKGCC for collaborating with KPMG to put this together. We are more than excited to do this. As I said, we've allowed some time, seeing that some people have entered the meeting room to allow us to successfully and easily ease into this. I will quickly go into our agenda and I will introduce who's here with us today and some recap we've had over our past webinars, and then we'll go through. So I'll quickly go through the introduction, as I mentioned, introduce our speakers, tell you who's here with us, recap our last webinar, some of our key things, why we are here today, what we want to discuss, and then what we hope to achieve when we are done with today's session. So I'll go ahead with the meeting etiquette of things we should note as we are going through this. There's a Q&A section of the Zoom call that we want to hear from you. So you ask your questions as the webinar is progressing. We would have a varied way of speaking to your questions. We'll either take intermittent pauses after sections we will handle, and we will come back to your questions, or at the end of the day, we'll take the questions all and then answer them. But we don't want you to forget the questions you want to ask us, so we would encourage that you keep dropping them in the Q&A section as we go on. I will read them as part of the webinar discussions that I'll have with my esteemed panelists, or as again I'll pause. We will give some chance to some people to also share their thoughts, to ask questions on the panel as well, to ask to our panelists as well. And for those who've sent questions ahead of the session, thank you very much. It's always a joy to receive thoughts from our panelists. So we are happy to have you here, and we'll go through that. So quickly, I will go through who's here with us, and I will give you a reflection of who they are. And so one may ask, who Chewa is, who John is, and myself, I'm sure if you follow this for a while, you know who I am. But I'll go quickly into who Chewa is. Chewa is, and she's the ENS, she's the Environmental Social and Impact Manager at Growth Investment Partners, Ghana, where she leads the development and implementation of environmental and social management systems and impact measurement frameworks that help guide responsible investment decisions. The word responsible, we'll hear that a lot today. She has more than a decade's experience in sustainable finance, ESG integration, and impact management. She has been at the forefront of embedding environmental and social management and social consideration to investment portfolios and business operations across Ghana's financial and corporate sectors. Before joining GIP, she served as the head of ESG at CBG, where she developed sustainability strategies and oversaw sustainable finance portfolios, and also led environmental and social risk management as Access Bank. So she comes with a wealth of experience from commercial banking and now sitting at the helm of affairs, leading that at GIP as she stands. Her profile is long, and I wouldn't bother with more than Chewa. We're happy to have you here. Thank you for joining and for being willing to share your experience. Please let's welcome her warmly as she. All right. So the next person we have with us here is John Ekokuteria. Is Africa Head of Sustainable Finance at KPMG. That's why I said an Associate Director for ESG Services, and he sits in Nigeria. He has 4 plus years, over a decade's experience in leadership in sustainable finance, institutional reform, and development finance. He has extensive expertise advising governments, financial institutions, and the private sector across East, West, and Southern Africa on designing, structuring, and operationalizing innovative finance mechanisms that support environmental and social sustainability objectives. In his current role, he leads KPMG's sustainable finance program across Africa, focusing on green, social, and sustainability bonds, gender smart finance, biodiversity, and nature based finance, blended finance solutions, and climate investment facilities. His work includes supporting financial regulators and intermediaries to build enabling environment for climate finance and integrating climate and ESG considerations into investment decisions. So he extends technical advisory support on climate aligned financing and partnerships that catalyze capital forward towards sustainable development on the continent. John, thank you for being with us here. We are more than excited to have you here to share your experience, your expertise, and help us demystify some things that have come to our table. So, John, we'd like to see you as you turn on the camera for us to discuss.
Right. Thank you, Bernard. We are happy to be here.
All right. So thank you, John, again for joining us. Our audience is more than ready and are itching to listen into what we brought to the table to discuss with them today. So I'll go, as I mentioned, the recap of our last webinars, our past 4 webinars, which has been over the last calendar year. We looked at 4 different areas. We looked at making ESG reporting work. We've looked at global ESG regulations and their impact on Ghanaian businesses. We've looked at embedding ESG into corporate strategy. And then the very recent one, we looked at ESG quality management from strategy through to reporting. Some takeaways from the very first one I mentioned is we have ESG myths still exist. Our speaker there spoke about some myths and asked the audience to speak about some myths that they've experienced in their work. And we were able to demystify that. And one of the things that makes me very excited to host this over for 5 consecutive times now is I met one person at a symposium and she came close and she mentioned that we've lightened the burden on their ESG journey. We've eased their understanding and then more so the way they operationalize these things. And it's rewarding and fulfilling to hear that people are impacted by the knowledge we are churning out and the impact we are making, what the knowledge we have and that we share. So we also takeaways continue to be around areas of risk of non-alignment, that's financing, trade access, and reputation. And that was under how global ESG regulations are shaping the impact on Ghanaian businesses. Then we have embedded ESG into corporate strategy. We had somebody from strategy. We had an associate director from strategy from KPMG, another from ESG, a senior manager from ESG. And together they came to explain how to embed the ESG in your corporate fabric through your strategy. Like they outlined how the opportunities far outweigh the risk if businesses act early. They also explained how the pathways to embedding this through governance, culture, tools, and KPIs. And we had different case studies we observed at that point in time. And then also the last one we had was on data quality management. And it was clear that over the other 3 we've spoken about, the missing link there was data and how quality data impacts the work we do in sustainability. And one of the things that stuck with me, we had a lady, and one of the things they told us that we should bring more ladies to have the conversation with us. So Chewa, you've made a lot of people happy today by joining and speaking today. So let's say that. And we made everything purple today too because we are celebrating women in this month. So I'm sure people will direct questions to you as well. That's fine. And the last one I said, ESG strategy sets the direction, but data tells the truth. Our panelists for the last one mentioned that ESG is a journey, and every journey needs a reliable compass. And in ESG, data is that compass. And one of the things that stuck with me throughout was that sustainability is not just about intentions. People think it's just about wanting to do good, feeling to do good. But then they mentioned that it's about showing evidence, and data is that evidence. So this is a short recap from our 4 series for last year. And we've come to today, and we've highlighted doing the ENS, the environmental and social due diligence, and how it's shaping today's conversation as capital is flowing through Africa. There's a lot of conversation about infrastructure development and how funds are flowing from other markets into Africa, and how Africa is defined as the world's, in the very close future, going to show a good growth potential. And for that reason, there's a lot of capital inflow here. And very in such conversations, there's the growth, and then there's a recent rise for the place of ENS in these flows. So how are they impacting the flows? Who's leading the charge on what to observe? So we'll go first into that, and then we'll take assets in the context. We'll listen to our panelists. But first, I'll go to John and say, from a sustainable finance and capital structuring perspective, why has environmental and social due diligence become non-negotiable in today's investment environment? That's the first question I have. So from a sustainable finance and capital structuring perspective, why has environmental and social due diligence become non-negotiable in today's investment environment? So over to you, John.
Thank you, Bernard. And also, thank you for the opportunity to share some of the insights, and also from experience how doing environmental and social due diligence is not just something that is done to be documented, or to be to put on an investment memo. It's now being looked at as if it's beyond a regulatory compliance matter. And why is it that is we normally do environmental and social diligence for either for a project, or for a transaction, or for an entity. And this now becomes an important feature where you just don't want to identify the risk of whether it's environmental or social topics within a transaction, or looking at whether it has some gaps that needs to be remediated. You're also looking at whether the project or the transaction has fulfilled its righteousness with regards to the legal requirements by the jurisdiction that it finds itself. So if it's a project, you are looking at whether they've done the ESIA requirements, and looking at whether the stipulations under the EIA or the licensing requirements, whether the client has been able to, or attempt to put in the right structures to fulfill all those righteousness. Now, I say righteousness because these are regulatory requirements. Also, from an investor point of view, they also want to find out, so they don't get their hands bent, to see whether, to what extent have you embarked on the journey, as you said, and also what are the key immediate gaps or immediate reporting timelines that are required in there. Now, from an investment point of view, and also to untapped sustainable finance opportunities, it's not just a risk assessment conversation, nor an impact conversation. It's also about how do we look at the opportunities that are within whether it's an environmental matter or a social matter. How can I position this partner or this transaction that I'm dealing with? How can I look at the value of it? And also, how can I either increase my investments or put in additional technical assistance to be able to bring them up to speed? A lot of development finance institutions would want to look at how do I bring them to a place where we can both go on a journey together, so that the impact that you are having, it's a shared impact, so that I can say that I invested in this let's say, financial institutions at the beginning of we doing the investment, they had no, let's say, they had no systems, or they had no, let's say, climate finance product, or they didn't have any structure in place regarding their environmental and social management system. Now, investors are looking at how do I showcase and demonstrate that due to my investment in this transaction, I've been able to bring some kind of additionality, or bring that kind of reform ordinarily that they wouldn't have done if that investment was not in place. They would have, but this investment also gives that perspective. And that value creation also comes to the point of view of how do I create that value, and also bring in either additional money or leverage from that investment, how I can able to bring in new products. We've seen instances where, and also like Chirao mentioned, that some of the investment that they do comes with some technical assistance where they provide them with consultants to help them to structure their current products so that they can be more feasible, and also bring in more pipelines for them. Now, this also brings that value, that not just looking at, am I doing a due diligence just to look at the gaps, but also looking at from a climate perspective, and also from a value and also a social consideration, how can I, or how can we together show impact throughout the journey, whether is it a 1 year journey or 2 year journey. This becomes a key matter in it. So back to the conversation, environmental, social, and due diligence are now evolving. It's not just aligning it to a standard, whether it's an IFC performance standard or the local requirement that is you're supposed to embed it, or if it's a World Bank project, whether you've aligned it with the environmental and social standards, or even an AFDB project or any DFI. It's not only just looking at it from that perspective, but also looking at how do I, yes, identify the gaps, see how I can be able to come up with additional support to also reform the current status and create value out of it. I'll pause here and yield the floor to the next question. Thank you.
All right, so thank you, John. And I'm gathering, I'm putting down some notes. So I put down the question was on why ENS has become non-negotiable in today's investment environment. And I see you mentioned regulatory requirements. That means there are some regulations that are moving towards how it's necessary for money to flow in a certain way that doesn't hamper environmental progress, and that doesn't stop people as well in the social area as well. So there are now regulatory penalties for that. That's what I gathered. That so that's why the ENS due diligence has become a core component of deciding whether or not a deal is a go or not, or a no go. That's one thing I gathered. I also gathered that there's from the investment point of view, there are investors that are actually looking forward to transform people's systems to adopt environmental and social responsible activities, in the sense that they are looking that their investment will drive some reforms, and then for, as a matter of, as you expressed, some new products that will echo environmental and social awareness. And I think lastly, what I got was, I mean, some investors are now becoming very aligned because of the regulatory, because they don't want their capital to flow in only to pay off a regulatory punishment. So these are the three key things I've gathered from your answer. And I'll say thank you for that. Chua, do you want to take a bite at that as well? I saw you nodding at some point, so please, the floor is yours.
Okay, thank you very much, Bernard, KPMG, UKGCC. I'm glad to be part of this esteemed panel. I'll add a bit to what John made mention of during his delivery. Personally, when it comes to ESDD, environmental and social due diligence, not being negotiable, I come from the responsible investing point of view. Gone were the days where companies were doing due diligence for potential investments with so much focus on traditional financial risk areas and targeting data around historical financials, cash flows, projections, all with the aim of mitigating any potential credit risk in the course of the investment. But if we have kept our eyes on the World Economic Forum Global Risk Report over the last couple of years, 3-4 years, you've realized that climate change issues, social issues, environmental, social related issues are gradually increasing. As at last year, about 70% of the global risk are environmental and social related. Example, extreme weather events, biodiversity loss, natural resource shortages here and there. You and I will agree with me that even in our neighborhoods, water is now a problem. And so we cannot afford to do investment irresponsibly. We need to bear in mind that whilst we are particularly interested in complying, we are interested in investing with all the financial considerations. The non-financials are also very, very, very important. Hence, we cannot continue doing investments or funding businesses that do not take these material, environmental, and social issues seriously. And so for me, I think it boils down to responsible investment. If you are an entity, beyond compliance, what do you stand for as an organization? I'm not sure any company would want to be seen in the news for any adverse impact from a project that has been financed by an entity like us. For us, GIP, we do not compromise on that because we believe that in as much as we want to add value, impacts, either positive or negative, adds to our brand as well. And so we treat ESDD as a non-negotiable, mainly because we believe it's the right thing to do. And at the end of the day, it's the basis on which we take our investment decisions. I think that's a little I'll add to what John already spoke about. Bernard.
Right. Thank you very much for that. And I'm happy that you mentioned that companies are seeking to improve their reputational outlook or awareness, so as not to do a deal only to be in the news for something negative. So we see regulatory, reputational, and then we see definitely investment to do some reforms and new products. So closely follow to that. And Chiwas, you already speak. You started talking about that. I'll say, so from your standpoint of view, what happens when the ENSDD is weak or is superficial? What happens? What are some of the things that could come out when it's not done to its best capacity? Thank you.
Thank you, Bernard. I think if an environmental and social due diligence process is weak, I would define the weak to mean box ticking exercise. Then there's something I usually say to my team that we are gradually or quietly sweeping risk under the carpet, which in the short, medium to long term will surface either in the form of high NPLs, in the form of fines, because we have companies that if you track over time, the amount of fines they have paid alone could pay our loan we gave them if they had done the right thing. And so for me, the main thing is if ESDD is superficial, if we sit in an office either as a commercial bank, as a private equity fund, as an entity like ours that finance purely SMEs, if we decide to, okay, we need to disburse a loan, we are working behind time, and so we need to make sure that we meet all our due targets for the year. And so we should just let this thing go. Then eventually we are likely to face high NPLs in the medium to long term. I've already talked about our reputation and negative publicity. Secondly, we also tend to ignore very material risk. So I'll give an example. So when it comes to doing DD, one area that is of interest to us is the social aspect of things, particularly because we play in the SME space, and which is typically informal, largely not guided by any policies or procedural manuals or structures. And so when it comes to social issues in DD, we tend to take keen interest on how labor issues are treated within the organization. Okay, they might not be documented on paper, but what are the processes, step-by-step processes that are done from recruitment, to retention, to training, to on and on and on. So in DD, we look at a whole lot of issues, from social to environment to even BI, business integrity. What are the systems in place to manage fraud? What are the systems in place to manage discrimination, grievance mechanism, a whole lot. The whole idea is we do not want to be superficial. We do not want to be seen to be doing the right thing when we are not doing it. And so if you are telling us, okay, we do A, B, C, D, the question now comes to what is the evidence? If ESDD has to be efficient and not superficial or weak, we expect that there's documentation to show, there's process to show, there's procedure, there's SOPs, there's data backing whatever we do, in order to make sure that whatever we do, identify, we don't miss any material risk in our investment. Because what I've realized is that any risk that is mixed during the DD process can surface in the cost of the investment, and to be honest, it's more costly and complex in nature to resolve than before DD. Whereas if these things are done well and they are picked up, we can put in measures in place, usually what we call action plans, guide the company to ensure that we regularize the ones that are so high in terms of risk before we commit any kind of investment. Finally, I would say that I believe there's a direct correlation with doing a very effective DD to the success or the quality of our portfolio. Why do I say that? I've been in this space for a while, and typically in every year we try to gather data. That is our annual monitoring reporting, ENS reporting. We gather data around fines that are recorded by organizations, injuries that or incident records, training records. And if you observe, you realize that if some organizations are also struggling to repay their loans, most of the time they are also not complying. Either you notice that over time, every year they are recording fines, or every year there are some issues that is, it might not be in the news, right? That's another area we usually look out for in terms of reputation. But if you are tracking it very well, you realize that all the time, organizations that fail to enhance their ESMSs end up not doing so well as far as our investments are concerned. So for me, if we need to ensure that we have very good portfolio or credit portfolio in place, then ESDD should not be superficial. It has to be done very well, evidence-based, and then monitored over time to ensure that compliance is continuous. I hope I've answered your question to an extent, Bernard.
Oh, you've answered it to a very deep extent, and I see your background coming into it. You made a statement on this costly later on when the things are found, and I know it's a building term to say that things are not picked from the planning before the structure is put up. When it's going to be repaired later in the building process, it's costly. So I was like, hey, she's putting us on some engineering as well. But that's amazing. And those were the very, very good things you mentioned. How the superficial impacts the non-performing loans, how high fines are paid, and overall, you began to establish something that I'm keen to later on pursue, and it's on the fact that companies that default on investment loans that are advanced to them, if we look keenly at them under a microscope, we'll see some social and environmental non-compliance there as well. So that's a great one I took from them. Before we move into the next one, I'll go back to John to ask him that. So the advent of environmental and social due diligence, who is driving the conversation, or will you say the regulator or the investor? Before we move to the next one, because I'm hearing investor, regulator. I just want to know who is driving it more. So I'll default to John to speak through. I see him thinking. He has his hand on his head. So before we move to the next,
so I mean, let's be realistic, right?
Okay.
I think where the money flows is where you'd want to know where the interest is, right?
Right.
The regulator is obvious. He'll be watching closely and ensuring that you do the right things. But also where the money is flowing. So you have likes like GIP who require any of their investments to go to have an environmental and social due diligence. And it's because they are trying to protect or look at their risk appetite to see whether they are in for this. Number two, I want to make this point that it is not an event. It's not an event that you do a due diligence and that's it. And you fold your arms expecting that your portfolio would be non-performing or will be performing in a good way. It's a journey, right? And just like journeys, once you do a due diligence becomes your baseline, a baseline through which you want to monitor and also see the corrective action plans or the mitigating, or as Joa said, the action plans that are required in, and also see when they ought to be closed and at what time. So since it's a journey, it goes throughout the lifetime of the investment. So it's not just a regulatory requirement. I always say that where you follow where the money is flowing or where the money is going, and try to treat those gaps in a way that you are protecting your assets that you've invested in, and also see how those action plans are immediately mitigated. And also, as Joa said, there are data points in there. How do you be able to demonstrate and show to the world that this is where I was? These are the jointly we've been able to remediate this in this way. So it's moving beyond just regulatory requirements, because the regulator will always be there, as I said. And you also see within the capital markets and also the listed entities, they are requiring that beyond you having that due diligence, some of the topics are also used for your reporting to ensure that you are not just having this on your shelf, but also continuously updating them and showing value through sustainability reports and therein.
All right. Thank you, John, for that. He spoke about where the money is flowing. He spoke about regulation and how, both of these are driving this in our conversation, especially being in our part of the world now. I'm already seeing questions come through, the live questions. And now that we've set the context, given the background to what's the ENSDD, why it's becoming a topical conversation, why it's now being added to loan covenants, why it's becoming condition precedent on money flowing and all that, we've understood that as where we are is definitely pivotal in investment decisions. So the next thing will be to move away from understanding why it's important now to looking at the scope of what it is. So I know that this webinar can definitely not exhaust that process or that mapping. So Cheryl, I'll come to you again, saying that for practitioners in the audience, and this is one of the questions that came to us, and that what does the proper, that qualifies the ENS due diligence? That means some that are being done, but they are termed, not my words, but proper ENS due diligence process involved. And then probably areas to cover when you look at what are some of the areas they should cover. So as practitioners on the call, What should they pay attention to in the process? What can they deem satisfiable or satisfactory of a due diligence process? Thank you.
Thank you again, Bernard. The term proper is what is making me ask if there's any process that is considered proper. I think that, to me, it boils down to proportionality. It boils down to the organization's existing policies and controls. So I would use my organization's management system as a way of how to show how environmental and social due diligence is done. Maybe somebody in the FI space will appreciate this process better. But I know that there are also some of the participants that are not in the FI space. So I would say that look critically at your organization. What are considered material, environmental, social, business integrity, governance risk to you? And then come up with a policy that demonstrates your commitment, your track record, and then capacity. Who is responsible for managing these environmental, social, governance issues within the organization, business integrity issues within the organization? How is it being done? What are the SOPs that guides the processes? So for my organization, I will take us through the step-by-step process we use in DD. So we have 6 levels of ENS due diligence. We have the pre-screening stage. We have the IC screening stage. We have the due diligence proper itself. And then we have the final IC. That's the investment committee, DD. And then we go into the investment agreement level, and then we go to portfolio monitoring and management. So what happens at the pre-screening stage? What happens is, assuming a portfolio company has approached us for a growth capital, and GIP provides capital to SMEs, mainly to grow them from one level to the other. And so they've approached that, say, a manufacturing company, and is interested in accessing maybe CAPEX for construction of a warehouse or to expand their operations. What is typically done at the pre-screening stage is we screen mainly against our internal exclusion list. So there are some sectors within the organization, within the various sectors that we as GIP does not finance. And so I'm sure for companies that have exclusion, they are not too different, but we have an additional exclusion, that is fossil fuel. But typically we are looking at things such as prostitution, forced labor, child labor issues. It's a tall list. So at that stage, it determines whether we are doing the investment or we are not. If we go through the exclusion screening stage and we are happy, then we move to the next stage where we prepare our screening, prepare to go into DD. But at that level, we do the risk rating. That's where we have our ENS categorization or risk rating, and then come up with key ENS risks. And the emphasis is key. It's not expected that if all the inherent risk in the proposed investments are 20, all of them are material. To us, what is material is what we are not ready to negotiate with. And so when it comes to, so I cited an example of manufacturing. What is the category we are placing it? And I'll go ahead to define it in subsequently. If it is a high risk, then what are the key risks in there for a manufacturing sector that we feel should be part of our scope for due diligence? So that we will rather do a deep dive during the ENSDD stage to say, okay, In a manufacturing space, occupational health and safety issue is big. What are we looking at in DD? So we draw a scope for it going into DD to say, okay, in DD, because for this particular sector, occupational health and safety issue is big, then in DD we should focus on what are the controls in place to manage potential occupational health and safety risk, i.e. fall at height, serious incidents, minor cases, whatever it is. What does the potential investment company have in place to ensure that these risks are managed? And so we'll look at things like occupational health and safety policy, procedure manuals, SOPs, training records, incident records, stuff like that, just to satisfy us that, well, the company is aware that this is a material risk in its operations and has indeed put in place controls. The controls does not mean they are perfect, but there's some system in place to manage them. So after we have set out this, then we go into full DD, where in GIP we have financial DD that goes on, we have commercial DD that goes on, we have legal DD that goes on, and then the ELS DD also goes on. At the end of the day, we work collaboratively because there are some legal DD that is done that feeds into ELS DD. So for instance, legal will typically do searches across the various agencies to say, okay, is the company registered? So we would take initial IRL formation request from our clients. We need to validate whether whatever has been shared are what they are supposed to be. Once those things are done, it might come up that, okay, the company, as I cited, is a manufacturing company. They require EPA permits possibly based on the adverse impact the operations has on the environment. Is that permit valid? Do they renew these permits when they expire? So I now get that data into my DD to say, okay, at this point in DD, it came up that they don't have at all, or they have but has expired. That is a feed into our DD report, that these are key issues that have come up in DD. And so what do we do in the investment process? Is it because the permit has expired, we are not going to do the transaction at all? Mind you, ESDD does not stop transactions. It's supposed to open investment committee or the investment decision makers' eyes to what can go wrong if the right protocols are not in place. And so we put all these things as part of the final paper that goes for investment approval. And once that is approved, we take these conditions into the investment agreement, maybe those in the commercial bank space, into our offer letters, into our loan agreement. We put it there that this is very material. EPA permits is a regulatory. Any non-compliance of a sort exposes us, so we are not willing to do it as a subsequent. It has to be a precedent. So we make it a condition precedent and part of the agreement. And one of the good ways to do this is to make sure you don't treat it as a compliance activity. Work with the company to understand why we feel it is more beneficial to them than even us for them to comply, and agree on the timelines for them to meet it. So once that is done, we put all other conditions that we feel in terms of rating can go as a subsequent. And then after the loan is disbursed, we continue to monitor. So John made a very key statement that it is a journey. It is not a one-off event. It's something that ESDD is something that we continuously monitor to ensure that value is added and then we continuously comply. There was something I wanted to define when it comes to the risk categorizations. In the IFC definition, we have either category A, that is a high-risk project. What is a high-risk project? We are saying that these are business activities that have potentially significant adverse impact, and they are diverse in nature. They are irreversible, and they are unprecedented. If you have a risk like that, Example, large-scale plantations, large infrastructure projects is a high risk. The definition is clear. My organization uses the European Development Finance Institution rating. So that has 4 levels. So the IFC has 3. It has category A, category B, category C. The EDFI has 4. It has category A, that is high risk. It has B+, that is medium high. It has medium low, and it has low. All of them provide clear guidance as to how you should categorize it. And based on the categorization, you define the level of DD you do. If it's a low risk, you don't necessarily have to even do a site visit. A desktop review of all the processes, the procedure documents made available to you can be sufficient for it, unless there's a need to do so. Medium risk, there's no way you can do a desktop DD. You need to visit the site, familiarize yourself with the process, confirm what is in the policy against what is implemented on ground to be sure that whatever system, environmental management system that is in place is robust enough to manage the risk. And then the high risk, most of the time we outsource it to external consultants to do, and these are experts in the field. So if we are doing a project that has a very high biodiversity impact, it's not expected that I know everything. You outsource them to experts in this field to provide you with better due diligence so that at the end of the day, it is not seen as a superficial exercise. I think I'll pause here so that Bernard, if there's any additional question or any areas I did not cover, I'll take that.
I have a lot I've written, and I'll tell you one interesting thing I was doing. I was marking my steps. I was going through my steps in my head on the due diligence because I realized that you started that you don't want to say what is proper, what is not proper, but you're going to walk through what you think will be sufficient enough. So one of the big things I took from that introduction was we need to be deliberate to understand the outcome we want to achieve, and that will even inform our process. So from the basis of telling us what not doing this could cause us, now when we are doing it, we'll be intentional to know that these steps will lead us to that objective. So rather don't necessarily be big on the steps per se that you have to do this to checklist, but make sure that in the end, these risks and other things are covered. And thank you for taking us through. I'm sure there are some questions I was going through that you began to answer. There were questions on categorization, and then you've rightfully explained that on depending on where you're coming from the IFC, that has a 3, or you mentioned another. And these are the things I consider. Someone was also asking on when they should either go to site or a DEX or review suffice, which you've spoken to. I'm deliberately re-echoing it so people know that their questions are being answered. And thank you. It's a very comprehensive answer. And I like how you said something. And one of the things we face on our calls or the knowledge platforms I've been on, not only here, but in my day-to-day conversations with people, is you said something that you cannot be the repertoire for all knowledge. When you were given the example of when you need some extensive biodiversity review, you default that to somebody who has deep expertise in that, again, so that you don't have a superficial due diligence. And these are some of the things that I'm thinking as student practitioners of ESG, we want to propagate, as I'll say. So, John, there's a question directly to you here now. And someone is saying that they're a young professional and they're trying to build expertise. So they are tailoring their findings, some of the things you mentioned, and they're saying that when you say they should look at where the money is going back on the due diligence, they're saying that, can you throw more context on that? Like, so as a specialist, in terms of sector-specific and contextual risk, what should they be on the lookout for? As you mentioned, and as the investor is tailoring that, what should they also add to the things they should learn? So that's a question in the chat box. Thank you.
Okay, that's a great question. So to answer your question, it's where the money. So when I started my career, when I went for the IFC programs, they mentioned something that money is fungible. And what this means that you cannot isolate a transaction and saying that I am not looking at the non-financial of a transaction. Money flows with the responsibility of both the environmental and social matters. So you cannot say that I am invested in this company and I'm looking at only the financing aspect of it. I'm also responsible for the aspects that require, okay, to what extent are they, let's say, not being socially responsible within their communities? Let's say I'm investing in this community, this transaction or this project in a community, and this project is noted to be polluting or causing harm to the constituents in the community. The question is, if I'm going to invest in this project, I'm equally responsible for the activities of that organization. Therefore, if there are grievances or there are matters arising within that community, it's going to have reputational impact on me. So I quite remember, to use an example, I worked on a project in Tema. And in closing the project, that's my previous life working in a bank. We looked at the desktop review of the transaction, did everything the desktop, went on site. But we failed to notice that when the project gets to commission, the emissions from that project or that facility would be endangering some lives within a particular community. And what we had to quickly do by engaging a consultant was, to what extent should we note so that in case in 10 years' time, this community comes back and says, because of your transaction or because of your operations, I've been able to get some health matters. How can you able to justify that? So what we did was to do a baseline to know the air quality around those areas and juxtapose it and monitor it on a yearly basis so that we know that our actions or our operations, the operations of the plant, in the next 5 years, in the next 10 years, if we have a class action suit that, well, you are the ones that have caused me to have an asthma, we can use that as a base to give that justification. So when there are class actions on such things, what happens is that it's going to impact on your expected revenue or your profit that you're going to have. What does it mean? Is that you will end up spending monies on fines, regulatory fines, or class action suits instead of money that was used to help with the proceeds of the profit. So, well, coming back to the matter about money is fungible, it means that you cannot ignore that when you are investing or looking at the transaction, you also are responsible for the profit and the financial flow that it brings or it yields, and therefore it will come back to you in the form of a penalty, to come back to you in the form of you remediating a reputational damage. Another example that we all know that there's a fast food joint that we all used to go in Ghana, and they had an issue of food poisoning, and the place got shut down for almost about 2 months. You could know the impact of sales that they lost and even some of the jobs that they lost from that. And imagine that, does that have implication on the revenue or profit? You could see that for yourself, that you saw that the company had to take a lot of times to clean its image in the public before it gets to normalcy. That is also a lost investment in there. You can imagine that if they had done the right thing and be doing those quality checks and made or had systems in place to avoid any food poisoning or whatsoever, you could see that the business would either have, I mean, revenue, or by now, let's say that the entity would have been listed onto an exchange, but they had to spend a lot of investment and money in cleaning out their image, managing their brand capital that has been built for a number of years. There are also other instances of financial institutions who have found themselves in this place where they they may have had systems or may have not categorized it rightly. As Joa would say, yeah, in the terms of you categorizing the risk aspect of it, maybe they classified it as a category B, but actually it's a category A. But also the financial institution may not take a keen on it because they are looking at the financial aspect of it and how much revenue or interest rates or interest margins they're going to get from that transaction. And out of that, when you Google one particular financial institution linked to, I won't say that aspect, something will pop up that ABC Bank looks on and finances this transaction. And what that is, anytime you want to go to the market to raise money, the name mentions pops up, and you have to do a lot of explaining. You have to do a lot of showing how you've been able to remediate that gap. And that brings a lot of investor insecurities. And like, okay, if you said you had this environmental and social management system, why couldn't you flag this during the life cycle of the project or of the investment? And those are the things that I see around this. A lot of organization and financial institutions and um, corporations who are into doing due diligence just do one due diligence, put it in application or the investment memo, and wait for it to crystallize or wait for it to exit. That's why the role of the environmental and social manager or the sustainability person is supposed to capture the environmental and social action points. So most entities will just do the reports and find a way to put in the application, but it has to be in the covenant. The covenants in the offer letter. That is what paints the business or the transaction to know that okay, I want you to have access to the facility, or I want you to do ABCD as the environmental and social commitment plans in the transaction. And this has to be tied with timelines and tied with responsibilities. If this is not tied in the offer letter or the contract that you're doing, whether it's a merger and acquisition, whether it's a transaction you are doing, or whether it's a due diligence even to a financial institution, nobody takes it serious. And you cannot be paying for it because it's not in the offer letter or the contract. Once it's in the agreement, the ENS person responsible for this will have to have a follow-up to check to what extent have you remediated this and also report it in an arm's length way. So back to the question, it is all about, and because money is key. I mean, if Bernard, if I ask you to do something and that if you do it, I'll give you this money, I believe you would do it. But if I don't add any monetary value to it, you would do it because yes, I mean, culture or regulatory would make you to do it. But this process works. It works in a way that if you do not, there are sanctions, or we will not release this money if you do not show evidence of complying to this action point. We will not do this and it works. And that is one of the tools that DFIs and investment corporations or funds use, that in a way of deploying a credit line, or deploying, and even banks do that. Banks will do that. So they have something called condition precedent and post disbursement conditions. So based on the closure of these action points, it also calls for unlocking or releases of those credit lines. Bernard.
All right, thank you, John. And in capturing that again, I've gotten how you've mentioned that investors are definitely influencing the conversation here, and I'll link that to something Chiwa mentioned. You also rehashed that depending on who is advancing the money. For example, when she mentioned the categorization, mentioned the IFC has it in A, B, and then C. And she also used another level saying A, B plus B, and then C. And if you do further reading, one of the things I realized with that is I think people feel the IFC is B is broad, so they want to split it to be able to capture the B plus and then a B as well. So definitely the money is advancing that conversation. I'll come back to John again, but I have some follow-up questions for Chiwa clearly here. I'll bunch 3 of them together so I still maximize time ahead of what we have to do. Someone is saying that they are thankful for going through all what you mentioned, but the question they're asking is, they're a beginner. They want to know what the difference between the ESDD is and what an ENS audit or assessment is. That's one. The same person wants to find out who performs the DD. Only FIs, potential investors, state or statutory agencies, independent parties, CSOs. I'm sure the person wants for learning purposes, want to understand beyond your investor, beyond the DFI, who does that. Then the last question is, when is it best to do the DD? Before commencement of operations or during operations? So these are the 3. Who does the DD? When is it best to do? And then the third one, they want to understand what the difference between the DD and then an audit or assessment is. So Chiwa, specifically to you. Thank you.
Okay, thank you, Bernard. I think I'll start by saying the objective is one. We have a common goal, but I would say ESDD or the due diligence usually is a pre to an investment, and then an audit is a post to an investment. But depending on where you sit, it should be an ongoing process. It should be something that periodically, once you do. So for us in the investment space, we'll usually do an environmental and social due diligence before we invest. But after the money is gone, we'll do audits every year to ensure that beyond meeting the action plans, the systems that were in the action plans, be developing a policy, be developing an SOP, instituting some training system, the audit will now let us know whether they are actually being practically implemented, but are not just documents sitting on the shelf somewhere that, you know, are being dusted every year, reviewed every year, but really no impact, any positive outcome. I think the second question has to do with, remind me again.
The second question has to do with who performs the DD.
Who performs the DD? So I think I gave us a bit of insight into that during the categorization stage. It depends on your organization, but for best practice, if the risk rating. So if the risk rating is a high, and in my case, a medium high, it is ideal that external consultants do the DD, people with the right expertise and background within an area. So for instance, we have a pool of consultants, but not every consultant can do every DD. So if we have an expert in agro processing or agric, that consultant might not be used for a manufacturing operation or might not be used for oil and gas, something operation. We don't do oil and gas, so let me correct that. So depending on the risk rating, external consultants can do that. If the risk is ideal, that if the risk is low, it can be done in-house. So in our case at GIP, if the sector or the investment is a medium low, we typically use in-house personnel to do the DD. If it is medium, high, and high, we engage external consultant. Now, who does due diligence? Everybody can do due diligence. So, for instance, in my case, in doing DD, I'm relying on, let's say, an agency, the EPA's report or impact assessment or whatever process or risk process they followed before they issue the permit as my basis for my due diligence to say, okay, if the regulator, who is an expert in this space, has issued a permit to satisfy that they have met A, B, C, D conditions, then it gives me some level of comfort beyond what I can also do. Assuming I'm relying on Ghana National Fire Service for a fire permit. You know, the fire service personnel will not just sit in an office and issue a permit. I stand to be corrected if you have received any line, but that is not the ideal process. The ideal process is that the personnel will come to the site, they are informed, they feel regarding what is supposed to be done, what are the systems that are supposed to be installed, what are the fire systems, what are the alarm systems. They come in, they test, they give time, and then based on that, they renew or issue a permit to you. I rely on that due diligence as well to do my due diligence. And so generally, within the organization, whoever is responsible, the audit function can do that, the ENS lead can do that. Outside the organization, we have external stakeholders that do that as well to help in the process. For instance, there have been instances where in the issuance of an EPA permit, EPA does stakeholder engagement depending on the impact of whatever the operation is. If it's a mining project, EPA will not go ahead to issue an EPA permit without they themselves doing an independent stakeholder engagement, to be sure. So whilst we expect that the company itself has a stakeholder engagement plan, evidence to show that they are doing a stakeholder engagement, we also rely on the regulators as well to confirm that these things were done and based on which permits were issued. I think I've done justice to the three questions. If I've missed any, kindly let me know.
Yes, you have done that, and that answers all. I want to just pick one from the live question, then we move back to our conversation. And anyone, please, John or Shua can speak to it. Say that how easy is it to obtain honest and willing responses from the potential customer? How do you manage the process to obtain the client's trust in the process? And I want to add to that question for my background. You know, sometimes when we go to do reviews, people are a little apprehensive towards it because the socialization of the impact of the exercise has not sunk deep with them. So rather than appreciating that this is to help bolster my future prospect as a business, they rather see it as something that will impede the flow of capital to them. So he's asking a question. I'm sure he's asking, how do you obtain honest and willing, first honest and then willing responses from potential, I'm sure, investees? So over to you. Anyone?
So let me start. So you, the person doing the due diligence, you need to. So first of all, there's a desktop review that you do, right? You based on information on the website or documentation that you received, you could know to what extent or what level they are in terms of maturity or whether they have the right systems. So normally what I really look at is, number one is the capacity. Do they have the capacity to manage these material topics that I'm looking for, right? Number two is, do they have the competency? And do they have also, so competency basically, do they have a dedicated team? Do they have um, how they are structured in the organization? Because I would also want to find out the qualification of the person responsible for this. It helps. It helps makes things easier. So I'll talk about capacity, competency, and capability. It also comes to the team structure. Are they capable? Capability, competency, and capacity. And the last one is our track record. And with this thumb rule, right, if I'm doing a due diligence on a financial institution or been taxed to do on any project, these three things helps me a lot. And the track record is the evidence. So if you tell me that you have a dedicated team, I want to ask you, can I see the team members, the organogram, and also I want to see the document evidence of your systems that you have. If you've gotten licensing or your ESI or regulatory requirement, I want to know the updated one, or whether you would, what are the provisions in there, whether you fulfilled all the righteousness within the various stipulations or things that you're supposed. And once I gather those ones during the preliminary stage, I now make an informed decisions to ask the right questions. And I ask in a way that, although I know the answers already, I want to, during the engagement, I get to unearth your capacity and ability to handle these matters. And being able to do that, it's a matter of you doing it many times, be able to come back. There's a learning curve that you get there. Now, yes, clients would or investees will be very apprehensive, but it's a matter of having a conversation and you knowing what right questions to hit them on. In previous working experiences, when we did some due diligence on financial institutions, I did my homework well, and before we get there, sometimes it gets quite heated because you have a responsibility to provide a report that is unbiased, that gives a true picture where they are. And sometimes you see the potential, let's say, financing of financial institutions that you want to give a no objection to, for them to be in partnership with our entity. You see that there's a kind of trying to hide behind their systems to give a certain impression. And because we do our homework well, and also we send in some questionnaires to solicit some information that comes in handy. And when we do our due diligence, it's more of like showing evidence. You said you have a document there. Show me the document. Let me know whether you even understand the process where you integrate this within your financial institution. And this becomes a conversation, and you pick signals when they don't have it. In some entities, when you enter, they will say, boss, I don't have the system, and it's easier for you to know how to even put in the right action plan that is workable, right? So, and I believe that Showa has several examples of how this pans out during her work. Another part that I want for projects, and also to add to that, Chowa mentioned IFC performance. There's one thing that we also use is getting information on the website also helps, and also your annual report, because gleaning information on your either sustainability report or the website already shows how you're serious around this, and it makes you writing the report quite easier. And also using the IFC performance standard. I using the World Bank standard. I literally prefer the World Bank standard because it provides kind of a detailed in-depth, and also has a place for financial intermediaries, which is an all-encompassing standard. And also, we also see that in certain jurisdictions, there are sustainability reporting requirements, which also helps, but not in that detail, because some of the narrations are more of like, okay, ambitions related or things that they are hoping to do, or even you see a lot of organization having an ESG system, or we want to go to the hard area. We call it an environmental and social management system. And even the way you even say this, it makes us understand whether you have the capacity to handle that, or whether you are just having the lip servicing approach, or saying that. All this becomes signals that we pick up when we are doing due diligence, because again, it comes with the capacity, your competency and capability. And that has a lot to do with whether we are comfortable in delivering or investing or deploying funds to an organization. Maybe, Joe, you may want to take the...
Yeah, thank you. John, I think you've said most of it, but I think in my space, I work with SMEs a lot, and you can't really hide as an SME. If you don't have it, you don't have it. You know, the moment we enter into your premises, if it's an organization that we don't expect that, maybe I'll still go back to OHS, is not undermined. I expect that the moment I enter your premises, you quickly do, some bit of training or OHS awareness session to let me know that, hey, you are in a high risk area, or this place is a no-go, this place is a go. I should look around to see some signages clearly displayed, if it's a construction site, a manufacturing site. So it comes back down to what John said. There has to be the capacity to be able to do it. There has to be the commitment from senior management. What are the policies that have been set out, to demonstrate that we are committed? What are the structures in place? Sometimes when we are doing the background of the roles and responsibilities for people within certain roles, we will go as far as asking you for their CVs, their backgrounds, on legal DD. Sometimes we go all the way to the regulators to do a background check on whether organizations are even paying the benefits of their workers. And we've had instances where an organization had over 50 workers, and the search showed only 23 of the workers had their state contributions paid. And so these are the things that the systems are there. These are the places that we go, the extent to which we go to get to confirm what is being shared with us. I think beyond that, I believe in a more collaborative approach. I realize that I kind of get into the minds of our potential investee companies when I don't go with the mindset of a compliance officer. You need to have this. If it is not this, the loan will not happen. No. Once you go like that, immediately they will not make certain things available to you. I've been able to sit on the client's premises for this year. We paid 2 fines. Why? It's the approach. I just said that you let them know that you are in there to help them to improve the system. The value addition is even more material to you than the compliance, because at the end of the day, to me, if the fine you paid last year is not paid this year, it's only feed into the bottom line, the profits, and it's a good indicator for me to even invest in you more. So I think that instead of adopting another way of doing that, instead of adopting, okay, the national regulation says that you should have EPA, you should have fire, you should have a list, a tall list for them. If it is not there, it's a no. It should rather be a more collaborative. Okay, are you aware? You see, so there's a way you can ask a question that will get the information you need, but not necessarily sounding as a police officer. So are you aware that this operation requires it? When was the last time we reviewed? I say, we have it all, but we reviewed it a long time ago. This does not mean we will not do the loan. We will do it. But you need to make sure that you take steps to renew before we sign the final agreement. So then it's a win-win. We are indirectly persuading you to do the right thing, but it's not a showstopper. For us, the approach we look at ESDD is, or ENS is, you might not have it now, and even in the space, it is still emerging. We expect to grow with you through the process. Where are you now? The more you come out to tell us what the real picture is. At GIP, we have the business support service handled by Ghana Investment Support Program. We've had instances where companies that did not end up even as a partner company, at the pipeline level, we have helped them develop their management systems through the support. So we support you to develop just because you made available information. We now identified the gaps and we felt, okay, let's use our business, even though as of now, we don't see that you are investment ready, but our business support service, based on the gap that was flagged, is able to provide you that service to come up to speed. We might invest in you next year, but that's not necessarily the reason why we did not invest. For one of them, we did a DD for them, and towards the end, another bank gave them a better offer. But mind you, we've developed their management system for them. And to us, that's the impact story. It did not come to us as a deal, but we supported them to develop their management. So I think that the best way to do it, be more collaborative, be more engaging. You get them to give you more information to support them develop their management systems. Thank you, Bernard.
All right. That's very rich. I mean, for what you yourself and then John have mentioned, these are very helpful. John started with capacity competence, and you added up to the collaborative approach. And definitely, I'll take the capacity and the competence on both ends, the investee and then the reviewer who is doing the ENS due diligence. So one of the things I've found out is that you've added to this is even our posture and carrying out this, because there's a question that you've answered that I will mention so that we don't have to go back to his own. So I was asking that, how do we make this exercise move beyond just a risk mitigation venture and then dovetail into the value that we bring to people? Because one of the things I found out, personally too in my work, is if we are not careful, people are fatigued by first the number of terms we have. We mention a long list of categorization. We give the long list of things. So people are already feeling the fatigue. So I'm happy that you've given us these 3 C's. So if anybody's going to forget something, remember that capacity on your end as a reviewer, your competence, the competence to be able to manage even where there are shortfalls on the end of the investee, and then collaborativeness, demonstrating that your intention is to add value, to drive value. Like you mentioned that one of the deals, you didn't close it, but eventually you developed their ESMS for them to be able to get capital from another investor. And that's amazing. I mean, kudos to you and the team. There's a question here that I want to read. I'm taking the questions quickly. I want to use the time well. There's a question on how and this one, the person says to Chewa, how the investor's perspective, from that perspective, how some of these findings that yourself have mentioned, John mentioned about a certain restaurant, we don't want to mention the name, how they translate into investment decisions. And I recall some minutes earlier, you mentioned about condition precedent when it has to do with a license issue from EPA. So I think this person is coming, I'm assuming the person is coming from a deal's point of view, that how is this earmarked into the overall deal process? Does it impact the figures? Does it impact the numbers? So questions around, are there some investment capex requirements and some strengthening? So there's the question that from that perspective, how do these findings translate into the decision itself? So it's to you, Chewa.
Okay, thank you, Bernard. I think that ENS is integrated in our investment process. And so ultimately our findings, as John mentioned, end up in the investment agreement, because at the end of the day, yes, we want to give you funds. We want to also ensure that the right things are done. We don't compromise on what needs to be done. And so, for instance, some findings that we feel are so material, it will not lead to a no-go. It will not let us say we will not invest in you. No, we would give you time. So we've had, I think I cited an example of this search from GRA, search from SNEDs, where employees' benefits are not being paid. We are not looking at it even from the perspective of income to the government. We are looking at the well-being of the employees within an organization, knowing very well that if the employees are happy, you get to see more productivity in your operations over time. And if they get to find out they are working when there's a standing contract that their benefit will be paid, but are not being done, they have implications in the future. So in that particular case, it was a precedent, and we made sure that the entity made payment to the SNIT, and shared evidence to us before we disbursed. Another way we deal with that is a situation where we are able to do tranche disbursement, and we know that it's not completely the responsibility of the company to get that to us. So the company has been able to make payments to the whatever entity it is. So Ghana Fire for a renewal of permit. Ghana Fire said, I'll get it. I need to go through my process. So it's 6 months. It is unfair to not give some money to the potential investee because of something that is not within his control. And so in that stage, we'll probably stagger the disbursement to say, okay, once you can submit the evidence that you have made some steps to correct whatever was found as a gap. However, we'll disburse this tranche first. Once the permit comes, we'll be able to make the subsequent tranches made available to you. And so there are various ways of handling it, and it depends on the investment committee and what, at the end of the day, decide is best we do. Ours as ENS leads and officers is to make the needed recommendation. Let the decision makers be aware that this risk is there. If it is not managed, it has consequences in the near future. And then recommend ways in which those can be handled. And then we monitor to ensure. And I think one of the things I want to mention is that post-disbursement monitoring is very, very, very important. Once the money is gone, if you don't keep your eye on the money, as John is saying, they would meet compliance to just get the money, but it will not be continuous. They will not continue to comply because after all, we have the money. If I don't pay, it doesn't matter. So that is where the ENS audit comes in. Continuously every year, we are following you. We are keeping an eye. I personally even have a permits tracker. So I track, so if you submit 10 permits to me, I'll track and remind you that coming next month, your permit, this particular permit is expiring. Initiate steps to renew them. So that is how practical the ENS DD and monitoring process can be. Thank you.
All right. Thank you very much. And I mean, very insightful. And then we get to see some of these things and to learn from them. And she's even gone ahead to tell us how post-disbursement tracking helps and then doing it in tranches. One of the push I get from both of you is your interest in making sure organizations that come under review, I'll not say scrutiny, under review are actually supported on their ENS journey. And I think as ENS professionals, that's our goal, to impart knowledge and then more so to course correct. So these are things that I've taken away. And there's another question on, so for time, I'm managing both on the questions that are live and the questions that were sent ahead. There's a question to Chewa on categorization, because you just mentioned something that will go there. And then John, I'll come back to you. I'll read the question to you. There are two questions to you, actually. there's someone saying that they want to understand what's the difference between ESS in government agencies is and ESG management in financial institutions. So the person wants to understand what the difference between the terminologies are. Again, I said we have a lot of want to understand, and then there's another that's close to that. The person is mentioning again on what's the difference between the IFC standard and World Bank standard. I think I've been in a conversation with John, and he's explained that before, the whole ESF, the framework from the World Bank, and then IFC performance standard. So someone's asking that question. And to add to that, the person saying that as an ES specialist hired to execute ESGD for an upcoming firm, what approach is a right to enable you interact efficiently and acquire what is expected for the investee firms? I believe you touched on that, but because it's part of the framework questions they're asking, I'll give that to you. Before, John, you come, I'll give the categorization so we maintain the flow. So this person works in a bank, and they say that to what level can they reduce the subjectivity of the categorization, because two different ENS officers have come out with different categorizations for the same investee. So yes, you explained earlier on, it depends on where it's coming from. Is it IFC you are using on this? But the person, I think the person is troubled. Maybe they go to review a loan, an investee, a colleague has done that, but the categorization is different. And we know that once the categorization is different, the treatment and then the furtherance conversation are also different. So the person is that, how do we reduce the subjectivity of that? And that one was targeted, it was sent to Chewa. Then John, when she's done, you just come in with the frameworks and then the dichotomy for us. Thank you.
Okay, thank you, Bernard. I think the definition from both the IFC and the EDFI are quite clear, very clear. Even though there's some level of subjectivity, for me, as long as you can justify your rating. Okay, so let me take the category A, for instance. So high risk is defined as businesses with potential significant adverse environmental and social impact that are diverse. Diverse meaning it's not at one place. It comes across in different, forms. It is affecting workforce. It's affecting communities around. It is affecting the environment. Waste. It's a whole lot. It is irreversible. So the impact is such that if it is done, it cannot come back to its original state. So example, you have done a land reclamation project. So you've reclaimed part of the sea. There's no way, once you have sunk all the whatever into the sea, to create a land where we call the harbor, you can revert it back to the sea. So the guidance for each of the ratings are quite clear. So what I use to make my life easy is that for high-risk projects, they have a very large infrastructure project, greenfield projects that would impact critical habitats. So if you have, you have the IFC performance standards being 8. If you have any investment that is triggering, so we have IFC triggered transactions. It is triggering from 1 to 8 is high risk. So you have biodiversity issues. You are doing large-scale plantation, and so you need to now acquire a greenfield, clear everything, and then there's some critical habitat in there that probably we might have lost. If it's triggering indigenous people, is high risk. So have it in mind that as long as the risk is triggering almost all the 8 ICE performance standards, it is a likely high risk. However, you are also checking controls that are in place. Now, you move to your category B. It says that they are projects with limited adverse environmental and social impact. But note, they are site-specific, and they can be mitigated by adequate measures. So for a manufacturing company, is it site-specific? Yes, it's located at one place. What are the likely issues there? Okay, employee labor and working conditions are there. maybe they have more women, so gender-based violence and harassment issues surfaces somewhere. These things are in there. They don't make it necessarily a high risk. They are within, it's medium, because once you put adequate controls, they can be managed. Now, low risk is saying that they have minimal or no impact at all. So, for example, you would be having an operation that is maybe service providers, consulting. Hardly do they have anything to do with the environment. Hardly do they have anything to do. If there's anything big, probably it's workforce. So, depending on these guidelines, you are able to categorize them. My answer to the subjectivity question is provide the justification. Why is your category not A and B? And be able to defend it. Once you can be able to defend that, between medium, high, and high, I strongly believe it's high because of A, B, C, D reason. It's good. So that is the way of addressing the subjectivity related to the risk rating. Thank you, Bernard.
All right, thank you for that. I like something you did. That even if someone even passes your exclusion or your high risk rating, what happens if they have hits on all 8 of the IFC performance, you should begin to reconsider them as a high. That's thank you for that. So because of time, I'll move straight to John, and then John, please take over from there, and I'll come back to Chewa. Then we take some.
Yeah, so let me just use 1 minute to add something to what Chewa said. So in certain financial institutions, or they had something called an easy tool. An easy tool was a tool that you put in various indicators that will populate whether it's a category A, category B, or a category C. It made things quite easier. But since we don't have that standard around, I mean, what Chewa mentioned is a good way to categorize whether it's a category A, B, or C. So back to the question that you asked, I think someone is asking the difference between the IFC performance standards and also the World Bank standard. So maybe so with yes, I've said that the World Bank standard has 10 standards, which is called the Environmental and Social Standard, which yields from an environmental and social framework, right? The IFC performance has 8, which is more focused on kind of risk specific. It has the first one that talks about the environmental and social and assessment and impact, which is like the mother standard through which those other standards that come from labor, working conditions, and other ones to 8 talks about those key specific material topics that maybe perhaps what you're doing. You would want to look at those specific aspects that you would want to address. So there are standards that guide you how to identify, assess, and manage, and also remediate those topics there. So for World Banks, it's majorly for World Bank projects and also World Bank's financial intermediaries that they want to deploy. And for World Bank, they have 2 other standards. One is for financial intermediaries, which is if they want to deploy some fund or make an investment to a financial institution or an instrument or a financial partner, they use that to be able to ensure that before that institution is set up, they have an environmental and social specialist on that project for financial institutions. And for World Bank standards, it is a prerequisite. You need to have an environmental and social commitment action plan done before any World Bank project. And this is prerequisite before even you think about executing the World Bank project. World Bank projects is more of a public. IFC is also more about private sector, and because IFC is more of a private sector driven. So I think I've been able to respond to the difference between that. Bernard, over to you.
All right, thank you so much, John, for that. And I'll remind the person asks a question, you've answered it, but I want to clarify so I can clear that. The person is asking of the right approach, the approach you right to enable you interact efficiently. So remember the 3 C's: capacity, competence, and then collaborativeness. So collaborate with the person. You demonstrate capacity by being able to make them understand, and then your competence in how to manage whatever comes up. Please, what's the last one?
It says capacity, capability, competence.
Oh, okay. That's fine. I'll add the last.
And
I'll add the last
collaboration.
Scene. Nice one. I think when we are done, the 3 of us can write a thought leader on the 4 C's. That's just by the way. So before I come back to both of you to close, we have about 5 minutes to do that. There's a question on climate. We'll touch on it if we don't go deep into maybe another session. We might be fully deep into that and how it plays in the investment space. But then I'll read that there are different questions, but I've bunched them together. There's how should climate risk be factored into the ESDD? How is climate risk categorized within the framework? And is it possible to integrate climate risk assessment in ESDD? So Choa, please, you go at that. Then if you want, you can add your closing remarks. John comes in a minute, and then I wrap it up because we had pressed for time at this point. Thank you.
Okay. I think maybe in addressing that, I would say already the E has the climate element already being addressed in your ENSD due diligence process. However, if you are doing an ESDD, environmental and social due diligence, for certain sectors, so you are doing for agri, you are doing for sectors that are exposed to the climate so much, you would have to extend the due diligence to cover physical risk, transition risk. Why am I saying that? So you have maybe an irrigation project. John and I worked on one irrigation project, and this is large-scale rice farming. And you and I know that climate one day can just let our investment go down the drain. And so there's no way you would do an ENS due diligence that is comprehensive if you've not narrowed down to look at what if flood happens. What's the location of the site? What's the impact that it doesn't rain? So depending on the sector, and I feel it will be material for certain sectors and not necessary for other sectors. So if one way to incorporate climate risk into your assessment, look at the sector in which the investment is going into. If it is a sector that would likely be affected or will have exposure to physical risk, like whatever, weather conditions, extreme weather conditions, floods, etc., then by all means, do a deep dive due diligence covering that. If you are in an organization, say, I usually give an example that, okay, if you are assessing a company that is, let's say, into automobile, fossil fuel powered cars, you are now asking yourself that with transition risk, which is an aspect of climate risk, if policy changes where Ghana wakes up one day and says that all of us should migrate to electric vehicles, then what is the impact on my investment if I have about 10% of my portfolio in this space? Or especially for most of our commercial banks where a lot of our deals are in the oil and gas space. So obviously, if we are all migrating to electric cars, then it means that the OMCs in our loan books are now beginning to record lower sales and all that. So it's about time we integrate all those processes in the due diligence process. But then again, it's important to add that it's still emerging, it's still a gray area we are learning. The more we read, the more we find out ways of embedding these climate risk in a risk assessment process. And I think for my closing remark, I would say that ENS, or environmental and social due diligence, for pipeline companies or companies interested in partnering with growth investment partners, we always support you through the process. We are not using the ESDD approach to not you have access to whatever investment you are looking to have. It's a hand-holding process at GIP. And I believe that other organizations or other commercial financial institutions can do the same. Let's treat ESDD as more collaborative, work with companies to develop their ESMSs, environmental and social management systems, and try to drive home the value addition, the value proposition, rather than focusing more on compliance. And then at the end of the day, we'll be able to all achieve the objective we are looking, or the outcome we are looking for. So thank you very much, Bernard, for being part of this panel discussion.
Okay, so I will just proceed, Bernard. Okay, so I'll just proceed to give the final remark. So from my side, ESDD is not an event. It shouldn't be treated as an event. That's okay, let's do it. It's a process, and this process is a continuous process from origination or when you're starting a project to the very day that you even want to exit. But even when you exit, you still, anything that happens later on can be investigated, or an evaluation can be done to even ascertain whether you did the right thing or not. So it's a lifestyle, it's a life cycle, and it has literally no end, because some of the projects or investments that were done have implications on future matters that will happen later. So even with the World Bank environmental and social assessment that are done, they even want to go back later on to know whether did the projects really affect the community, and also did it yield this impact that it was intended for. So my last remarks also is looking at the value aspect of it. Chiwa has mentioned a lot of financial institutions, or when projects, they want to indicate about the risk and the impact. You could also put as part of your memo or your credit document the value that you hope to achieve from that, which comes in quite handy. I'll pause here, and Bernard, thank you for making time, and also our partner, our people who are participants who joined us. We are grateful for your time and also staying us throughout the session. Thank you.
All right. So thank you, Chowa. Thank you, John. Thank you, everybody who joined. UKGCC, thank you. We will continue the conversations on the platforms. Emails can still be sent to myself, who will speak to that. My name is Bernard Selikem Japasu. I've been your host for today. I'm a manager with KPMG, and it's been a very good learning experience for all of us. Thank you, Chowa, once again. Everybody's happy with what they lead.
Thank you so much.
And thank you, John. All right, so please have a good rest of the day and week. And to Ghanaians, happy Independence Day in advance. And to our women, happy International Women's Day and Week celebration to all of you. Cheers and goodbye.